Hello. Today we're going to be talking about U.S. Steel. First, we're going to go through a few things for disclosure and housekeeping, and then we will talk about U.S. Steel Corporation. Alright, first of all, this isn't professional advice. I don't hold any licenses or certifications or anything. The joke, as they say, unquoteth the Raven, nobody should follow this advice, including me. And I just want to make sure that nobody piles in their life savings into this and something unexpected happens, which is always something that one should expect with investments, and they end up with hideous losses. Fair use. Basically just disclosing that anything that I use that's copyrighted or trademark I'm using under fair use doctrine. Alright, so general overall under U.S. Steel. Let's see. Again, in general, the stock is trading about where it normally is traded over a number of years. But the big thing, or the big attraction for it, is this low price to earnings ratio going forward. So the question is when this period is over of high earnings, is there going to be really much value left to it, or is it going to have dismal earnings, or even worse, going to be actually producing losses, making it like a long-term dog? However, again, this initially is what attracted me to the stock. Price to earnings ratio going forward for this year of under 2. Alright, so just a few more reminders. At the moment, it does look like a good buy. There's a large margin of safety. Any people that are value investors or readers of Graham and Dodd would recognize that phrase. At least for the next year, it looks like good earnings, but then the question is what happens after that. It's also going to be part of what I call the materials inflation trade. Looks like we're going to have inflation going forward, and the steel producer should benefit from that. One recommendation I have, that if you do end up buying, you should only, always only invest what you can afford to lose, and don't put any more than 10. Maybe if you're enthusiastic about something, 20% into any one position. That way, if there's just simple volatility or something unexpected happens, you don't get blown out. And as a full disclosure, I do own some shares of U.S. Steel, and at times I'll write call options on it. Basically, what it is that I'm basically giving somebody the right for, I usually do month, 3, 4 or 5 weeks out, so I'm giving somebody for 30 days or so the right to buy the shares at a higher price than they bought it. Now, the disadvantage of doing something like that is that while the stock may rise more than that and the shares get called away, over time, that's probably not likely to happen. If it does happen, I make, several percent in a month, which is, going back historically, is actually a good trade. And if the stock doesn't really rise or falls even a little, at least I collected the premiums on the options. If you don't know what options are, just leave them alone. Alright, so basically what I'm going to do is we're going to look at a 1, 5, and 10-year charts. I discussed a little about the price to earnings ratio, the price summary. Then we'll look at some financials, and we'll look at the latest 10Q quarterly report. Alright, so first off, basically, here's a year to date. Again, this is the big thing that's attractive to it. So the question is, and the reason why the stock's probably not trading higher, is that the way it's trading is that most people are probably going to expect that this is just going to be for a little while thing, and then the price will sort of go back to normal. Market cap's a little over $6 billion. Short interest isn't too high, so you're not going to get like any kind of strange squeeze situations. But again, if you're owning the stock, you would only benefit from that if it was to happen. Yield is actually quite dismal. Very small yield. And the question is going forward, are they going to be able to generate earnings consistently and actually maybe up that yield? And I think that could happen in several years, but it's kind of hard at this point to see. the main thing will be is, once this price spike in their products over, are they going to be consistently profitable, or are they going to be sort of like just sort of like stumbling along? Again, the large range over the last week, but most of that was because the 1 year comparative was when a lot of things were shut down. Again, I expect that things are going to be trading a little higher as they are now than they have been over the past year. All right, so that's the 1 year comparison. Then we do a 5 year comparison. So here's what we see. And again, basically, because of what happened in 2020, one of the comparatives I would use to try to figure out, how's this going to be long term is what things were prior for 2019 and earlier. So it seems, or it looks like in the past, that things were much better for the company. And again, that's the 5 year, which sort of implies that if things were to sort of return to more normal, maybe the stock would trade up at that. And then we have the 10 year, and we find that it's only off around 10 or 11%. So right now the price basically is about where it normally has been the last decade or so. All right, so here we got a few years of comparisons. The trailing 12 months, I'm just looking to see. All right, so October 28th was the end of the third quarter. So, as you can look, this trailing 12 months, it's a huge increase over anything that's been going on the last several years as far as revenue. And we know that that's really, quote, real sales, not just some inflation thing, mostly. Because if you look at the gross profit, it's, just for the prior 12 months, it's higher than it's ever been. Again, 2020 is unusually low because of what was going on with the outbreak. But again, you see the prior 2 years varies between 1 to 2 billion gross profit. Again, because of the large price rise, operating income skyrocketed, whereas even at best it was only $1 billion. Let's see, let's go down here. Earnings from continuing operations again. Last 12 months, $3 billion versus the best prior to any year recently is only $1 billion. And same thing with net income to the company. Let's see. Foreign sales, again, really doesn't, it just bounces around, not really anything unusual. All right, let's go take a look at the, wait a minute, I thought they had a book value here. Wait a minute, let me see if I can find that. All right, now I don't see that. All right, let's go over and take a look at the quarterly report. Wait a minute. All right, so again, here we have a 3-month comparison and a 9-month. Now, again, 2020's numbers are going to be rather dismal because a lot of stuff was shut down and everything. However, the thing that we see, again, reasonable sales or high sales, that they're actually earning money. One interesting thing, though, it seems like that maybe something's going on that's bunching it up, because here you got the 9-month number of 3.1, but the 3-month number for some reason is 2 billion. So it looks like something happened and bunched it all up in a quarter. Wait a minute. Let's go. All right. Let's go on to the balance sheet. Again, cash is about where it is normally. Assets are high, but that's probably just because of higher sales. Property, plant, and equipment's up, so it looks like they bought something. Goodwill's up, so that is a definite indicator they bought something for over its book value, so it got booked as goodwill. liabilities are much higher, but that's probably because of the higher sales are supporting higher payables. This is interesting in that long-term debt's actually down 400 million or so, while most of the other things are staying stable. Common stock, they did do a little issuing of a common stock, about, I think it was 300 or 400 million this year worth of it. Additional paid in capital is up. However, this is one of the big things. They were actually, their retained earnings was actually negative, and they actually recovered into a positive. And again, you look at the total equity, it's up over double what it was last year. So it looks like that they definitely have recovered from the depths of the outbreak last year, and they're doing, not only have they made up all the ground they lost, but they're ahead. Here we have the cash flow sheet. Here, net cash flow by operating activities. So here you have 2.6 billion profit versus about 150 million loss. So just straight operations, it's actually throwing off cash for the 9 months. The other interesting one, if you look, they bought Big River Steel for 625 million. Capital expenditures were only different by about, I don't know, 130 million or so. However, so it looks like that their investing was actually a little less than last year net, even though they bought something. But one of the big things here, they repaid a big chunk of long-term debt. So even with all this cash generating and still sitting on the balance sheet, they were even able to pay off a whole bunch of debt. And if you take a look here, well, again, going back to the balance sheet, all right? So last year, last December and at the end of this October, they had about 2 billion in cash on the balance sheet. And that, if you look here, you know, they still add that much even after they paid about 2 billion back, where last year they were drawing down all kinds of money to keep operating. So that basically tells us that their profit is what some people would call like real profit. That, you know, it's actually turning into cash, and they're able to do stuff like pay debt, buy other stuff, and everything. So basically, it looks like the company is throwing off cash. They are paying down debt. I think the reason why the stock isn't trading up is because people really don't know what to think about this large earnings all at once. They don't know how long it's going to last. And that was one, and I guess the basically the only real quote comparison I would take is the December 2019 full year number to try to figure that out. Basically, you know, and my impression back then is the economy was starting to top out a little and even start declining. So I would expect at worst going forward that they should at least do that. Now, of course, the problem though is, well, actually you got sort of like a conflict here between the 2 years. You know, 2018 they made 1.1 billion. 2019 they made 630. I mean, they lost 630 million. So the question is going forward, what kind of year are they going to have? Are they going to have 2018 type years or 2019? Or is it going to be like 2017 where they're just not going to really kind of go anywhere? I would expect, if I had to pick, that it would be more leaning towards at least the 2017 year at worst, meaning they're going to make at least a reasonable amount of money, and maybe 2018 type years, simply because they seem to be buying up other stuff, and that they're all, and at the same time while they're doing that, they're even paying off debt. Now again, steel industry is highly cyclical. However, we are going into what appears to be a high inflation period. I'm sure many people are aware that it looks like that, you know, they're trying to pass another 1.6 trillion in spending on top of all the other spending that they've done. One of the things that I think that would normally save a stock price like this, if there was somebody doing stuff like what I call jamming the price higher, like they had a big stock buyback program or something. However, with a market cap of only 6 billion, I don't really see that really anybody really doing anything like that, or a Tesla like gamma squeeze, basically where people buy far out of the money call option weeklies and try to jack up the stock price. And because it's such a capital intensive industry, I don't think the typical retail person's going to pile into it. However, long term, even if the price stays where it is, the volatility on the stock seems rather high, and because of that, the premium on the call options are high. So basically, long term, I hope to keep writing call. I hope the price is somewhat stable, and I keep writing monthly call options on it, and that way, I get a reasonably high rate of return off of the stock just by holding it and doing that. Now the thing is that, and again, because it's not like steel's really in favor, I could easily see where the price actually starts dropping. However, because there's, again, the equity that we just saw on the balance sheet is at 7, almost 8 trillion. We're going to be piling on another large blowout year on top of that. So even if the stock does start dropping for whatever reason, these things should be, as long as they keep up, would be a reason why people would actually want to buy more of it with the money they have invested. And again, the worst that I would say is that you're buying a company making money and trading for below its tangible, its book value, and possibly even its tangible book value at some point. So it's kind of hard to get really into too much trouble. And the thing is that, maybe at some point in the future, it returns to where it was trading in the past, and you start having, good capital gains on the stock over the next few years. So one thing that I'd like to make, that if you do end up buying in at some point, if you end up 50 or 100%, that I would always recommend you take some profit, and hopefully you're able to take enough to cover your cost. Basically, if you do that, and the worst that happens is the stock keeps going up, you just don't make as much money. You could always invest it in something that does just as well or even better. However, the reason to do that is that way, if something changes, say 5 years out, all of a sudden new management decides they're going to go start buying up everything in sight, and they just pay whatever they need to get it, and the stock turns into a dog and dropping. You're not there. While you're not happy that the short term that that it's declined, at least the long term you're still ahead on the overall position in trade. And also, one of the best things after you can do with any position is, after a while, when you're up long enough, or you've collected enough, say, call premiums or dividends, is that at some point you're going to be playing with the house's money. So you can actually have a position that you could afford to hold for decades. The only thing you got to watch out for is that it doesn't drop totally to zero. Basically, my plan long term with this is to hold some of this as an inflation materials trade, as long as that looks like it's going on, which, as long as we keep running large government deficits, I expect. I expect possibly at times I may write call options against the entire position, because I really don't expect this is going to spike like a tech stock would. And again, I personally like 30-day expiration, because you get a reasonable amount of what they call theta, which is the time element in an option, and it decays relatively quickly, and then you can, once a 30-day period's over and the call option's expired, either buy it back if it's in a profit, or let it expire. And then probably what I'm expecting is that in a year or two, people would need to come back and take a look at the earnings to see, are they still earning abnormally high earnings, or if the earnings settle down to what we could more typically expect going forward, and whether or not it makes sense to keep holding it or not. I'd like to thank you for your time. Comments and questions are welcome. You can email me. There's also a Twitter feed, and I look forward to talking to people